Because most of the questions which we have are of two types. Well, when we see income tax in our question, there are two types of questions. Obviously, either it will be in question number one or two, or it will be in 20 marks question. Both cases, I do not see income tax comings in the paper, and it's a question involving only income tax. It is usually income tax plus CGT, sometimes income tax plus CGT and IHT. And when it is in scenario question, it is mostly income tax, CGT, and IHT. And sometimes when it is in scenario question, comprising of 35 marks, he adds a little bit explanations or implications relating to VAT as well. So we do not see income tax coming alone in the paper, but yes, most of the times it would be income tax and CGT, maybe income tax and IHT, maybe income tax, CGT and IHT. And if it is 35 marks question, yes, income tax, CGT, IHT, VAT, and sometimes a little bit of corporation tax as well. So, if we talk about income tax, well, the first thing which comes into the mind of an individual is whether I am chargeable to UK income tax or not. Well, for that, we will be discussing the overseas aspects of individuals. But till then, let's have as much knowledge as much is required to start income tax. Well, if an individual earns income from UK and if he's earning income from overseas, whether he's liable to UK income tax or not. Well, if someone is earning incomes from UK, make sure, regardless of his status being not resident or resident or even resident and domiciled, make sure UK incomes would be taxable if earned by any of them, either resident or not resident or resident as well as domiciled. Whereas if someone is not resident and earns overseas income, yes, this is the individual who can enjoy an exempt income. So that would not be taxable in UK because he do not belong here. He's not getting a lot of benefits from our state, and that's why. Whereas if someone is resident and domiciled, in that case, yes, overseas incomes are taxable. But for resident individuals, there are two options, either on remittance basis or on a rising basis. But for resident and domiciled individual, it is always taxable on a rising basis. So, in a summary, we can say if someone is either not resident, resident, or resident and domiciled, no matter if the income earned from UK, that would remain taxable. But if someone is earning an overseas income, in that case, yes, if the individual is not resident, overseas incomes would be exempt. If the individual is resident and domiciled, all of his overseas incomes would be taxable. But if the individual is resident and resident but not domiciled, in that case he would have two options to tax his incomes, either on remittance basis or on a rising basis. Well, we'll be discussing the concept in more detail when once we will be at the overseas aspects of individuals. But as far as UK incomes are concerned, now we are quite clear that all the UK incomes would be taxable regardless of the status. So, this is how we compute basic income tax computation, which is usually we prepare when we are attempting paper of F6. But yes, sometimes we being lucky, we prepare income tax computation in P6 as well. In and well, we have three categories over here in which we divide the income of an individual. If he's earning trading profit, employment income, property income, well, we put them in other incomes, or we call them non-savings income. So there are three names, in fact: other income, earned income, and non-saving incomes. Well, all the interest, either from government guilds or from banks or from debentures of some company, or any sort of interest, are to be pooled in saving income. Well, dividends clearly represents what we have to put in this category. Obviously, dividends. Then out of total income, we total them up and we call them total income, and out of total income we deduct reliefs. Well, what do we have in reliefs? We will be studying that in a while, but make sure if you ever got to deduct some amount, deduct them in priority from non-savings, then from savings, and then from dividends, because the highest applicable income tax rates are on non-savings, a little lower on savings, and the most lowest rate are of dividends. Then we deduct personal allowances and we have taxable incomes. We apply relevant rates of non-saving, saving, and dividend upon them, and we end up with a figure in which which could be either tax liability and payable in the absence of all this what we have written over here. But if someone has invested any amount into qualifying EIS shares or VCT shares, well, we know 30% of that could be deducted from income tax liability, which could reduce the liability to zero, but it cannot create a refund. Same goes with SEIS, but in that case, 50% of the investment would qualify to be tax reducer. And if individual is earning an overseas income and UK does not have a double taxation treaty with that country, in that case you would also be required to deduct double taxation relief, which would obviously be the lower tax of both countries. Well, the child allowance which we receive from the state is needed to be added back if someone is earning adjusted net incomes above £50,000. Everyone does not have to repay this child allowance from the state, but those individuals whose adjusted net incomes are more than £50,000, yes, they have to. They have to repay some of this amount if their incomes are above 50,000 and below 60,000. But if an individual's adjusted net income is above 60,000, he is not entitled for any child allowance, so he repay all of the child allowance to HMRC. So if anyone has to repay that, put that one as an increase in the tax liability, and then you can deduct if there are any tax deducted at source. Well, for P6 students, if you want to know that what would be the tax deducted at source you might be facing in the paper, that would be the three. Either it will be pay on your salary, or it would be an income which you have received from discretionary trust, as they are supposed to be net of 45% tax, and that's why we gross them up with 100 over 55. Or if the income is coming from interest in possession trust. Well, from such trust, which is called interest in possession trust, if an individual receives some income, well, that would be dependent upon whether it's the non-saving or saving income. In that case, it would be grossed up with 100 over 80 and deduction at source will be 20%. But if it is dividend income which you are receiving from interest in possession trust, in that case we gross it up with 7.5%. All right. So This would be tax deducted resource which we have already paid to the government, or government would have already deducted from our incomes. Well, the things which we have still not discussed are, first of all, we have not discussed that what do we have in reliefs, and secondly, what are the rates of income tax. We'll be discussing that. Now, let's have a focus on reliefs. Well, reliefs is something which we can deduct from total income, and it comprises of two things. One is if there are trading losses in the same tax year. For example, if I'm preparing computation for 17-18, and in 17-18 I have found out that there are trading losses and I don't want to carry them forward, I can deduct them straight away from the same tax year out of total incomes, calling them as if they are my reliefs. Well, there are five more options how to relieve trade losses if an individual is incurring them, which we'll be studying. The trading losses, as trading losses is one of the very important concept with respect to income tax. Most of the times whenever it is a trader, your examiner have to put into your exams, yes, out of 10 times, 6 times he's suffering losses. So, how to relieve trading losses? One of the method is that if you want to relieve the loss of 17-18 in 17-18, you can do that, and you should keep in mind that if you are deducting same year's losses from the same year, like if there are losses of 17-18 and you want to deduct them in the same tax year, you'll be doing that from the total income. So, one of the things in reliefs is trading losses, and the other thing is interest paid in respect of qualifying loans. Well, the loans which will qualify are these following four loans. One is that those loans which were borrowed to invest in partnership as a capital, or maybe in partnership you borrowed a loan, and you further loan that money to your partnership in order to purchase plant and machinery, in which case it is only qualifying for 4 years. That interest should be deducted from total income for 4 years. Well, if your client have borrowed a loan and invested to purchase shares of a closed company residing in UK or European economic area, well, in that case, again, the loan is qualifying. But if the same company happens to be a qualifying EIS company, then individuals would have to decide either the loan borrowed in order to subscribe for EIS shares should be considered as qualifying and you should deduct its interest, or you can deduct 30% reducer I was discussing to be deducted from the tax liability. So either of them, and yes, more preferable approach would be to claim tax reducer, because that provides a lot more relief as compared to just deducting interest of some loan. Well, the next thing which qualifies if a loan is borrowed to invest in a employee controlled unquoted company but by employee of that company, that also qualifies to be deducted. That interest also qualifies to be deducted from total income. Well, if an employee purchases any equipment to be used for employment duties, but he purchased that by borrowing the money, once again this interest on this borrowing is allowed to be deducted from total income. Or lastly, if someone borrows to pay death liabilities of a deceased person, maybe that someone would be the residue legatee to that deceased person, and he would be liable to the IHT, or maybe the other liabilities this deceased person has owed at the date of death. But in this case, loan is qualifying and interest is only allowed to be deducted for one tax year. Well, as I mentioned, that if you invest any money into a closed company, if you want to know that what is closed company, I have written the definition over here. Now we know what are the reliefs which are deducted from the total income in order to identify what is net income. Next thing will be Next thing would be that we should deduct personal allowance of 11,500 out of it, and then we apply rates to it. Well, I have provided a summary of which of the incomes are received gross, which are net, and which are exempt for your later consideration, so that you can give it a good reading for solving future purposes. Well, these are the rates which are applicable to non-saving savings and dividends. Well, starting rate band is up to 5,000, then basic rate band is up to 33,500, starting from 5,001, and then high rate band start from 33,501 to 150,000 and above 150,000. Well, 20, 20, 20, 40, 45. Starting rate is nil, then basic is 20, 40, 45, 7.5, 7.5, 32.5, and 38.1. But the most important thing in this attempt is these nil rate bands, which are applicable before the application of basic rate band or even high rate band. Well, these special nil rate bands are applicable in saving income depending upon whether the individual is basic, higher, or additional. So, before applying basic rate band, these pounds will use basic rate band, but at the rate of 0%. So, but in dividends, make sure if you're basic, if you're higher or additional, doesn't matter. You would be provided with 5,000 of nil rate band in any case. So these are the rates which we apply in order to find out that what are the applicable taxes. So we have a little example over here. For example, we have property income of 25,000, we have interest income of 5,000, and then dividends are of 20,000. As there are no reliefs in the scenario, so we can say these are the total or net incomes, out of which I have deducted personal losses, and the taxable incomes are these. Now, if you look at that 13,500 of non-saving has been taxed at 20%. Then then comes savings income. Well, it needs a little bit of correction over here. Let me solve that again for you. Well, 13,500 of non-saving would be taxed at 20%, but now, as we can see that this individual is earning a taxable incomes of 38,500, which makes him a higher rate taxpayer. So if someone is a higher rate taxpayer, out of savings income, 500 would be at 0%. So out of 5,000, 500 would attract no taxes, and remaining 4,500 of the savings income would be taxed at 20%. And now we would say the basic rate band of 33,500, 13,500 has been used by non-savings, 5,000 has been used by savings, and for dividends, obviously we would be left with 15,000. Now, in the dividend incomes, we would say that this 20,000, first 5,000 would be at 0, and then next 10,000 would be at 7.5, which is basic rate band, and then remaining 5,000 would be at 32.5%. So this is how we will be computing the tax liability of this individual. Well, moving on, the basic rate band which I mentioned is of 33,500, and high rate band which ends at 150,000. Make sure they are 33,500 and they are 1,50,000 only in the case if individual does not make any payment into either personal pension nor gifted donation. If individual, if the client you are dealing has already paid an amount into personal pension or gifted donation, make sure we have to extend their basic as well as high rate band ending limits, but with the gross amounts. You have to cross them up with 100 over 80. Well, I've mentioned that in the table I was referring to you guys earlier. So basic band needs to be extended. So here is an example. Helen, whose only income is her salary of 58,000, she pays 2,000 gross into personal pension contribution. Calculate Harry's income tax liability for the tax year 17-18. Well, the employment income is 58,000. Well, I would suggest that you could have a look at that, and then I'll be continuing. Well, the employment income is 58,000, 11,000 is 11,500 is the personal allowance, but for this individual, basic rate band would not be 33,500. I've extended it with 2,000. Well, the 2,000 is already gross, so you need not to gross it up. So you just simply have to add it up into the basic rate band, which would become 35,500. And so first 35,500 would attract 20% tax rather than 33,500. Well, the personal allowance, which I mentioned earlier, is 11,500. That is for those individuals whose adjusted net income is up to or less than 100,000. If you have a look at that, those individuals whose adjusted net income are £100,000 or below, yes, those are the individuals who qualify for full personal allowance. But first thing is, what is adjusted net income? Well, the same two things which increases your basic and high rate band ending limit, decreases your net income and make it adjusted net income, which is the relevant amount which we have to consider when comparing with 100,000 in order to know whether he'll be provided with full personal allowance or personal allowance is to be limited. So you can set up some simple straight lines that anyone whose adjusted net incomes are 100,000 or below, 11,500, 123,000 or above would not qualify for any personal allowance, but something more than 100,000 but less than 123, in that case you have to reduce his or her personal allowance by a pound after every two which are above 100,000. So we use a reduced personal allowance. If ANIs are within 100 to 123, we use full personal allowance if it is 100,000 or below, and we use nothing if it is above 123,000. Well, I've included some examples for your consideration in this regard, so that you can go through with them afterwards. Well, another interesting thing and election which is available is that we can transfer but a fixed amount of personal allowance within spouses or registered civil partners. Well, this could only be done if both spouses are basic rate taxpayer. Otherwise, this election is not available if any of them is a high rate taxpayer. So you have to focus on 2 to 3 things. One is the fixed amount of personal allowance, and second is make sure it is only permitted if both of the spouses are basic rate taxpayer. It is not permitted if any of them is an additional or high rate. If permitted, what we are allowed? Well, we are allowed to transfer 10% of actual personal allowance, which is 1150. Well, and how the claiming spouse would be incorporating this additional personal allowance? Well, for example, right now we have Paul and Rai, who's a married couple, and the taxable income of Rai is 30 and Paul is 7,000. Now, clearly, Rai is using his personal allowance completely, but not Paul, because for Paul, his trading profits are below 11,500. So Paul could make an election over here to transfer his fixed amount of personal allowance to Rai. Well, if he would be doing that, how Rai would be claiming that personal allowance? If you can see, the taxable incomes which are given for Paul are 30,000, but they are already taxable income. So that means out of the 30,000, we have already deducted Paul's Rai's own personal allowance, but not the 1150 which has been transferred to him by his spouse. As we still continue to deduct the same personal allowance which Rai was originally entitled to, 11,500, calculate his taxable incomes of 30,000, and then we apply rate on it, which would be basic because this election is only available if both the spouses are basic rate taxpayer. And once we are done with calculation of tax liability, then we are allowed to deduct a 20% of the transferred amount, that is 1150. And that would be exactly 230 to be deducted from the tax liability of the claimant spouse. So we are not actually allowed to get an actual increase in the personal allowance. Rather, we are allowed to deduct the tax savings from the tax in respect of transfer of that personal allowance. And the amount would remain fixed at 10% of the personal allowance. Well, as I was mentioning, while I was discussing the pro forma part, that those individuals who receives child benefit from the state, well, for those individuals, we do not have a good news if they are earning anything above 50,000. If ANIs, the ANIs which I already showed you how to calculate while I was calculating availability of personal allowance. Same adjusted net income is to be considered again if you want to know that whether this individual is required to repay any child allowance. No, one would not be required to do so if an adjusted net incomes are £50,000 or less. But if they are £60,000 or above, he would have to add all of the amount of child benefit which he had received at the first place. But those individuals with ANIs of above 50 and below 60,000, they have to add back or repay 1% of the child benefit received after every £100 which are above 50,000. Well, in the following example, if you can see what we are doing for Helen. Well, Helen's only source of income is her salary of 58,000 a year. She pays a pension contribution of 2,000 per year. Her husband, Andy, has no income as he looks after couple's 3 children, and he received child benefits of 2,501 during the tax year 17-18. Well, now we have a couple who is looking after their children and they are receiving child allowance of 2,501. Make sure out of couple, whoever would be earning higher income, more income, would have to repay this child allowance, and there will be no implications of this child allowance repayment on the other spouse. So for here, we will say Andy has nothing to do with the repayment of this child allowance, but Helen has to. Well, I have computed the tax liability of Helen already, which is given over here. Now, if you can look into that, what amount of child allowance he had to repay, for that there would be a working too. Well, there we go. First of all, the adjusted incomes for Helen are actually the total incomes. Well, because we can say our total incomes are 58,000. If we can look into the scenario, if she has paid any personal pension contribution, which she does of 2,000 per year, and if there are any gift aid donations, well, there aren't any. So as we can see that this 2,000 which she paid into personal pension would reduce her adjusted net income by an amount of gross pension contribution. Well, the net contribution which he does was 2,000. So grossing it up with 100 over 80, sorry, would become 2,500, and that's why adjusted incomes are 53,300, 500. Now, in this case, we would say, what is the amount above 50,000, that is 3,500? Well, we have to give back 1% after every 100, which is above 50,000. So she needs to repay 873.5 to HMRC. So we are going to add this into her tax liability. Well, that is all how we compute the basic income tax. Now we want to have a look at whether that how to compute someone's employment income if we have to, and then we will be studying trading profits, and then we will be moving towards investment incomes if we would have some extra time left in the session. Well, the first income which we are going to discuss over here is employment income. Well, in employment income, sometimes we are required to discuss that whether this individual is actually employed on or self-employed. Well, most of the individuals in UK or most of the countries, they wanted to be self-employed because of the privileges of not deducting the taxes at source, paying lower NICs, relaxed rules of allowable expenses, better treatment of trading losses, and much, much, much more. That's why we sometimes have to consider a scenario in the paper that whether the individual is an employee or self-employed. Well, these are the points you should consider while answering such questions. In order to compute the basic, well, once you have decided by applying those points that whether an individual is employed or self-employed, next thing would be to compute his or her employment income. Well, in employment income, I usually divide them into three parts. One is the cash part, salaries, wages, bonuses, commissions, golden handshakes, which everyone usually do not prefer, or golden halos, which yes, everyone prefers. Second thing is the in-kind portion, benefits which are in cash, benefits which are in kind, and then any payments made by an employee which are considered as allowable deductions. So the third portion is this one, and this is the most smallest portion. Well, the common examples, well, I should not say examples. Well, the common allowable deductions which we usually used to see in the paper are these: subscriptions if they are paid to approved professional bodies, or contribution not into personal pension, into an occupational pension scheme. Well, that is also an allowable deduction to be deducted from employment income. Donations which are given under GAYE or under payroll deduction schemes, those are also deductible from your income tax liabilities. And then if there are any professional liabilities or if there are any insurance costs being paid in respect of professional liabilities. Now, this one is a little technical. For example, if you are a salesman in a jewelry shop, and in your shelf, the shelf you were responsible for, if you lost some of the jewelry out of that shelf, well, you'll be responsible or you'll be professionally liable for this payment. Uh, you'll be professionally liable for this payment or loss, and we'll be calling that payment of professional liabilities. And if someone gets himself or herself insured for that beforehand, in that case allowable deduction would be insurance cost. And lastly, we have this criteria: any expense which is not any one of above, it would be allowable deduction if it is wholly, exclusively, and necessarily for the purpose of performance of duties. Well, I was saying the fifth allowable deduction, any expense which sounds you wholly, exclusively, and necessarily for the purpose of performance of duties. Well, um, when we say any expense which is wholly, exclusively, and necessarily for the purpose of performance of duties, well, all those expenses which are qualifying these two tests. One is called remoteness test, another is called duality test. Well, if an expense is not remote from employment, it is relevant, it is directly related to your employment, and secondly, it does not have duality in it. It should be serving one purpose, and that is employment. Only in that case, any expense out of the pocket of an employee would be allowable deduction to be deducted from employment income, or it would be any of these four. So either any of the above stated four allowable deductions or any expense which fulfills these two tests would be allowable deduction to be deducted from employment income. Now, as far as salary, wages, bonuses, and commissions are concerned, well, these are not the figures which we are concerned about in the paper, but how to compute. Well, these are given usually straight away in the paper of P6, but I have given the relevant criteria that how we used to compute them clerically, especially in paper F6. Over here, we are straight away given with whatever the salary is. Otherwise, you have to compute it on accrual basis for a tax year. And for bonuses and commissions, we use whatever is the earlier date, either the payment date or the date when an individual becomes entitled to it. Whereas the benefits in kind which we might be seeking in the paper would be both, which you have studied in paper F6, as well as some of the new benefits which we have not seen in paper F6. Well, those benefits are share options, share incentives, and payments made on redundancy or retirement. So let's have a overview that how to compute taxable benefits in kind if one has been receiving them in the paper. Well, if in the paper your client is provided with a living accommodation, first thing is if it is job related, it would be job related. If it is either necessary for performance of duties or it is provided as a security arrangement. Such kind of accommodation, provision of accommodation, is an exempt benefit for employees. On the other hand, if an accommodation is provided to an employee for personal use, that is the time when he is not on job. So in these kind of accommodations, the first factor which you should notice is whether these are rented or these are employer owned accommodations. Right. If the accommodation is rented, the taxable benefit in kind for employee would be higher off two things which will be provided in your exams. One is annual rent and the other is annual or rateable value, which is calculated by HMRC. So if it is rented, you just have to find out two amounts in your paper and you have to pick whatever is higher. But if it is an accommodation which is owned by your employer, in that case, your taxable benefit in kind would be dependent upon what was the cost of purchase of this accommodation. If it was £75,000 or below, your taxable benefit would remain annual value, which would be given in your exams. But if it is an accommodation which your employer had purchased for more than 75,000, in that case, we will use the annual value which is given in our exams, and then we have to add an additional benefit into it, which is calculated by this formula, which is cost of providing minus any amount above 75,000. So in short, you're calculating amount above 75,000 and you're multiplying that with official rate of interest in order to find what is the benefit in kind in respect of the amount above 75,000 and add that into the annual value, and that is your taxable benefit in kind. But what would be this cost of providing, whether it is market value or it is the cost on which this home was purchased by your employer? Well, in some cases you would be using market value, and in some cases you would have to use original cost. Well, those cases are, for that you have to look into when accommodation was purchased by employer and when it was provided to employee. Well, if this duration is up to 6 years and if this duration is more than 6 years. Well, if employer purchased and provided within 6 years to the employee, in that case, the cost of providing to be used in this formula will be the original cost on which this house was originally purchased, and then adding all the enhancement expenses, but only excluding those which are incurred in the current tax year. So that's a kind of little exemption being provided by HMRC, that you could exclude those enhancement expenses which are in the current tax year. But if this duration, when employer purchased the accommodation and provided to employee, is more than 6 years, well, in that case, you would use market value of the house when it was provided. As we are using market value when provided, we should not add those enhancement expenses which are before the date of providing. We should only add, in this case, those enhancement expenses which are incurred after providing date but before the start of current tax year, because current tax year enhancement expenses are not to be added in any case. Well, here is an example for your consideration, in which Mr. JD's total taxable benefits are to be calculated for 17-18. For now, we would only be focusing on the living accommodation, as in this accommodation we have been provided with certain other benefits in kinds as well. Well, let's have the look at that what kind of accommodation Mr. JD is actually enjoying. Mr. JD, a director of X Limited, lives in a furnished company flat that cost the company 100,000. So it is an accommodation of more than 75,000. On 1st July 12, he occupied the property. From 15th June 12, the accommodation is not job related. The annual value of the flat is 2,500 and Mr. JD pays a rent of 150 per month to his employer. Furniture worth in the property is 6,000 and company pays 2,000 of the running cost of the flat and 1,500 of the council taxes. Well, we will be coming back to these things when we'll be done with these benefits as well. Right now, let's focus on living accommodation. As we can see, it is an accommodation costing more than 75,000. So we should start with accounting for whatever is the annual value of this accommodation. Then, as accommodation has a cost of 100,000, we will find out whatever the amount is above that, and we'll multiply it with 2.5% official rate of interest. This is the additional benefit. And right now, the taxable benefit was 3125. But as we can see, employee is repaying 150 per month to his employer, well, that would not give rise to taxable benefit. At least the amount which has been contributed back to employer, that is 150 into 12, 1800, and so the living accommodation benefit is 1325. Well, for the other benefits, we have to wait a bit. Now, the next benefit in kind, which you might see in your paper, would be that someone has been provided with a car or use of car. Well, if someone is provided with the use of a pool car, a car which is only supposed to be used for official traveling and are to be parked in the office premises once the office is off. Well, these cars are only for performance of duties, and that's why they are exempt. But the car which is given to you, allocated to you, which you can take home, are the cars which are considered as cars for either personal use only or personal and performance of duties both. But both, no matter it is used for personal purposes only or it is used for both, taxable benefit would remain same. Well, how to compute that taxable benefit? We have to find out the list price of the car as well as CO2 emission percentage. As well as list price is concerned, well, that's quite simple. First of all, you have to ignore any discounts. For example, if in the paper he says that he's been provided with a car which cost his employer 26,000, whereas the official distribution price of the same car was 30, ignore discounts or gross of discounts means you should use 30,000. If there are any additional accessories being installed at the cost of employer, yes, you would have to add them into this original price which you have identified. And then if an employee contributes towards the purchase cost of the car, well, that contribution is allowed to be deducted. But on amount of up to maximum of 5,000. So if I'm contributing 3,000, you're going to deduct 3. But if I'm contributing 8,000, you're only going to deduct 5,000 out of it. So this is how you will calculate list price. And the next thing which you have to calculate is CO2 emission percentage. Well, you will be provided very clearly that what grams per kilometer a car is emitting. You just simply have to find out that what would be the percentage on these certain grams. So I've given you a scale over here for up to 95 grams per kilometer of CO2. For any car which emits above 95, still we will say for up to 95 there is 18%, and for grams which are above 95, we will add a percent after every 5 grams which are above 95 grams per kilometer. So supposedly if a car emits 100 grams per kilometer, so definitely we'll say for first 95 it will be 18%, and then for as many fives we have above that, so that will end up in 19% percentage. But for diesel powered cars, whatever percentage you find out, you have to add 3 into it. If it's a diesel powered car which emits, for example, 70 grams, the percentage to be used will be 13 plus 3, 16%. If this 100 grams per kilometer car was diesel powered, you have to add plus 3, and this would become 22%. So make sure if it's a diesel powered car, whatever the percentage I have mentioned, you have to add a 3% into it because of emission of chlorofluorocarbon out of the diesel powered cars. Well, now the last point is applicable to both either diesel or petrol. Make sure this restriction applies to both. Maximum percentage which you can use in the formula of calculation of taxable benefit on a private used car is restricted to 37%. So either diesel or petrol, nothing more than 37%. Well, as I was saying, along with the car, as you can see in the question of living accommodation, along with the living accommodation, yes, there was furniture in the property, as well as running costs and council tax of the property was paid by the employer. And from that one paragraph, we were actually calculating three benefits in kind. Well, same might happen with the car as well, because along with the car, you may be provided with running cost of the car, but right now we are talking about other than fuel. Well, make sure all the running cost, maintenance, repairs, road tax, insurance, all of these costs are running cost other than fuel, and they are completely exempt regardless of the car being used for private purposes or not. Well, the parking cost while performance of duties while the office hours is completely exempt, but make sure if your parking fines are paid by your employer, they would still be a taxable benefit in kind. And if you're provided with a chauffeur, well, that chauffeur is totally dependent upon which car he is driving you for. Well, if it's a pool car is exempt and so does the chauffeur. But if it is a car which is private used car, well, in that case, if you are provided with a chauffeur, whatever the cost been paid by your employer would be a taxable benefit in kind. Well, we have a little example relating to car benefits over here, which I would like you to have a look at and solve. Sai took up employment with ROM Limited on 1st July 17. His remuneration package included a 2-year-old petrol-driven car with a list price of 28,000. He took the delivery on 1st July 17. Now that's important because we are calculating taxable benefit for 1718. Now, if you will multiply the list price relevant CO2 emission percentage, make sure you will be calculating taxable benefit for complete 12 months. As the car has been provided on 1st July, so the car was not available in April, May, and June. So he only used the car in this tax year for 9 months. So whatever the taxable benefit would have to apportion that one. Well, the CO2 emission of the car was 229 grams. I'm afraid it's going to be restricted up to maximum of 37% because it's quite a CO2 emission. As a condition of car being made available to him for private motoring, Chai paid 150 per month for the car during 2017-18. Well, ROM Limited incurred following expenses in respect of Chai's car: servicing, insurance, and maintenance. Well, all of these are running costs excluding fuel. All of them are exempt. The only benefit which would be taxable on Chai out of all this data is car benefit. Now, let's have a look at the solution. As we can see, the car has 229s. If you would have calculated the percentage, that would be quite above 37. So I've restricted it to 37%. Now 28,000 multiplied with 37% would be a taxable benefit for the year. As we can see, he did not use the car for complete year. So that's why I'm apportioning it to 9 by 12 and also deducting the employee contribution of 9 months out of it, and so taxable benefit is 6420. All the costs which were paid in respect of servicing, insurance, and maintenance would be considered as running cost other than fuel and would be exempt. But as you can see, fuel benefit is not an exempt benefit if you are provided for private traveling. Well, once again, if the fuel is only provided to you for performance of duties, well, that's exempt. But if the fuel is provided to you for either only private purposes or maybe private and performance of duties both, it would give rise to same taxable benefit in kind, and that would be 22,600 multiplied by CO2 emission percentage, which you would have already calculated while calculating the car benefit. But the only exceptional thing about fuel benefit is that we do not deduct any contributions towards fuel as we deducted in the case of car. In the case of living accommodation, we will be deducting them in every taxable benefit in kind if employee would be contributing them, but we won't if it is a benefit received in respect of private fuel. Because whatever the benefit of private fuel, whatever the amount of taxable benefit in respect of private fuel you guys will calculate, that is to be taxable completely regardless of its contribution. Now, in continuing with the same example which we started, ROM Limited provided chai fuel of 2500, of which 1150 was for business purposes, so chai was provided with private fuel. In this case, we will ignore what was the actual cost of fuel being provided to chai. We just have to notice whether he has been provided with private fuel for private traveling or not. If yes, the taxable benefit would be 22,600 multiplied by the same CO2 emission percentage, and taxable benefit will be 8362. Although he contributed 50 per month, but we are gonna ignore that because we cannot deduct any contributions out of fuel benefit. Well, as far as when benefit is concerned, well, that's the most easiest benefit because you just have to remember that it is 3230 per annum per van. Now, why it is per annum per van? Well, that's because if the same van is used by more than one employee for private purposes, 3230 is divided equally, and the van benefit is completely exempt if van is for normal commuting, pick and drop, traveling to and from home to office only. In that case, use of such van is exempt. Well, if along with van you have been provided with fuel, the taxable benefit would be just like the benefit of van. You do not have to calculate that. You do not have to calculate van fuel benefit of 610. But I would like to mention over here that if along with van you have been provided with the running cost of the van, well, that is something which is again exempt, but not the fuel. Fuel would remain taxable benefit at 610. And just like the fuel for car, you are again not allowed to deduct any contributions out of fuel from van. So in short, what I'm asking you to remember is we do not deduct contributions by employee to employer out of any benefit in respect of fuel, either car or van. Alright, now the statutory mileage scale or statutory mileage allowance. Well, I said in the first place, if an employee is provided with fuel for business traveling or traveling for performance of duties only, in that case, benefit is exempt. Well, if an employee is reimbursing fuel for business purposes, in that case, he would be first of all, why would an employee would do that? Because being an employee, I would never pay for business traveling. But if I would ever do that, yes, we might consider such an employee for allowable deductions. Well, now, if an employee is been provided with only fuel for business traveling, well, yes, that would be exempt. As we can see, if a car is provided for business traveling, pool cars, yes, those are exempt. If living accommodation is provided for performance of duties, job-related accommodation, well, that's exempt. If a van is also provided for performance of duties only, it's exempt. Or you can set a rule in your mind, anything which is provided to an employee for performance of duties only, well, that's exempt, including fuels. Yes. All right. Now, as far as statutory mileage allowance is concerned, well, this should come into your mind when an employee uses his or her private car, motorcycle, cycle for performance of duties. So, whenever an employee wants to make an expense claim from his employer, or to make an allowable deduction, in that case, the scale which we have to use in respect of his or her car or motorcycle or cycle is this, which has been given by HMRC. Now, the point is that if in the exams an employee says that he drove his own car for 2,000 miles for performance of duties, and in the first place that employee says that he drove these 2,000 miles on his own expense, well, something which should come into your mind: an employee driving 2,000 miles for performance of duties on his own car out of his own pocket, well, this will give rise to an allowable deduction, but not up to an amount of actual expense. If the employee says there was an actual expense of like £3,000 on this traveling, we will ignore this and we will use these miles and this scale in order to find that what is the amount of allowable deduction. So 2,000 miles are up to 20,000 miles, so we will multiply them with 0.45, and that will be actually £900, and that would be the expense claim in the eyes of HMRC rather than the actual cost. Well, if my employer repays any of the amount out of statutory mileage scale, that would become an exempt benefit, and if my employer repays any amount above 0.45 and 0.25, if these are miles above 10,000, well, that would give rise to a taxable benefit. So the rule I'm discussing over here is employee uses his or her own conveyance for performance of duties. If employer do not reimburse anything, these would be your expense these would be your expense claims in order to identify the amount of allowable deduction. But if an employer repays any amount out of in respect of this traveling, well, you have to compare that amount with these limits. If an employer pays anything above these amounts, that would be a taxable benefit in kind. Anything above these amounts would be a taxable benefit in kind. Well, precisely these. Taxable benefit in kind, if your employer pays you equals to it, well, that is exempt benefit. But if your employer pays less than or pays nothing at all as compared to these scales, yes, that would be an allowable deduction. Well, the passenger allowance, that should come into your mind whenever an employee carries a person other than himself from his office while performance of duties. An employer pays some extra amount in respect of that. Well, for passenger allowance, one should keep in mind that it does not create allowable deduction. That is, if a person is provided with passenger allowance of up to 5 pence or less than 5 pence, it would be exempt. It would not be considered as allowable deduction. Whereas, if an employee is provided with passenger allowance of more than 5 pence, for example, 8 pence, 3 pence would be taxable benefit. Well, I've been using a term, traveling for performance of duties. Let's have a look at which of the traveling is considered as performance of duties and which of the traveling is considered as private. Well, If we think about a person who is such a gentleman who has only three things in his life, that is home, permanent office, and temporary place of work, well, any other place which is coming into your mind would be certainly private. So, right now, while on performance of duties, what are your traveling which are considered as performance of duties, and which are the traveling which are considered as private? Well, something which we all do not like very much is that your daily commuting from home to office and office to home is considered as private traveling for statutory mileage allowance treatment in your paper. So, and by the HMRC. So, this traveling is private. You cannot claim any expense claim or allowable deduction for traveling from home to the office for which you contracted for. But from the permanent office to any temporary place of work, and from then back to your permanent office, all of this traveling is considered as performance of duties. Or sometimes we are seconded to some temporary office, or sometimes when we are doing an audit, our firm requires us to go straight away to the client rather than coming to the office and then going to the client. Well, in those cases, if you have been appointed for traveling directly from your home to temporary place of work or temporary place of work to your home, well, this traveling is again considered as performance of duties if it is you have been appointed for a period of less than 2 years. If you have been appointed on this traveling for more than 2 years, well, that one is considered as private. So this is how you differentiate if in the paper you are not provided with how many private miles and how many business miles an individual has commuted, so that you can compare, you can use them in working of statutory mileage allowance either to calculate taxable benefit or to calculate taxable benefit or to calculate allowable deduction, or if your employer pays exactly equals to statutory mileage, then an exempt benefit. But make sure any amount which would be paid to you for traveling, which is considered as private, make sure you are not allowed to deduct any statutory mileage allowance out of that. Okay, next thing which we may consider is private use of employer provided asset. Well, when I say that, we have already looked into many of the assets, such as van, car, or living accommodation. Well, you can say this rule applies on except for van, except for car, and except for living accommodation. Those benefits for which we have a specific rule, we do not need to apply this general rule on that. Well, if you are facing a scenario in which your client, employee, is provided with anything, any asset, which is employer provided asset available to employee for private use, but it is not car, van, or living accommodation. For example, if it's a motorcycle, for example, if it's a laptop or a desktop or maybe furniture in a private living accommodation, all such benefits we use just one rule, and that is use of asset. Well, that rule is quite simple and straight, and that is 20% of the cost is your taxable benefit in kind. What if our employer gifts us with some asset? Maybe it would be an asset which was given to us earlier for private use, and then ultimately it was given to us as a gift. Or maybe employer would have charged a price quite less than the market value. So how to compute taxable benefit if we are not provided with an asset for just use, if we have been gifted with an asset by our employer? Well, in that case, you have to do two calculations and you have to pick whatever is higher of both. Well, the first calculation is market value when the asset was gifted to you, and price which was paid by the employee, if any. Well, that will be your first value, which would not be the taxable benefit. If second would be higher, because you have to pick higher of both. Well, the second calculation is only required if this asset was available to you for personal use. And then afterwards, employer made up his mind to give it to you altogether. So, as a gift. So, if, for example, I have been provided with a furniture at 6th of April 2016. So, but at that time, furniture was provided to me for just using it. It was not gifted to me. So, in the tax year 1617, I used the furniture, and the taxable benefit which you would have been calculating for me in 1617 will be 20% of the cost. But in 1718, let's say on 6th of April 17, my employer gifts this asset to me. Now in this case, you would do two calculations, the first one and also the second one. But if my employer gives us an asset straight away as a gift to me, in that case, only first calculation would be sufficient. So if you are dealing a scenario in which the asset was earlier given for private use and then afterwards it was given as a gift, well, in that case, you have to do two calculations and you have to pick higher of both. Well, in this case, I would use, rather than the market value at the date of gift, I would use cost when it was originally provided. And then I would deduct benefits so far already have been taxed. Well, in my case, in this example, that would be cost into 20%. As I have used it only for 1 year, so that would be sufficient. If the same furniture would have been provided to me in 15, well, in that case, I would have used it for two complete tax years. That is 15, 16, and then 16, 17. Well, in that case, I will multiply this with 2. So, and then price paid, if any. So whatever is higher, that is your taxable benefit in kind. All right, I have provided an example along with solution for your consideration. You can have a look at it. All right, so Ruby was provided with a new laptop by his employer, by her employer actually, on 6th of October 2015, costing £3,000. He was allowed to keep the laptop on 5th January 2018 when its market value was 1,000. So initially it was given to him or her, I'm not sure. It was given for private use, and then ultimately it was allowed to keep it. So it was gifted on 5th January 2018. Now the point to be noted is that it was gifted to her on 1718, but in 1718, first 9 months, it was owned by her employer, and the benefit you are required to calculate is use of asset. And then we will be calculating gift of asset as well. So my point in 1718 is there is not only one benefit, you have to calculate, compute two of them and then add them both in 1718. So in 1516 we would say as the laptop belongs to employer, you are just allowed to use for it, and it was provided on 6th of October 15. That would be in fact 6 months of use. So that's why the taxable benefit would be just 300. Whereas in 1617, she used the laptop for a whole year, and so the taxable benefit will be 600. But in 1718, she used it for 9 months. And then it was her own laptop because of the gift. As he did not pay anything, so there is no price paid. Now, how to compute taxable benefit in respect of this gift of asset? Let's have a look at that working as well. Well, the first working, market value less price paid. As she did not pay any price, so first value will be 1,000. Well, the second value would be market value when first made available, that is the original cost, 3,000. Then benefits which have already been taxed, which we already calculated in the first place, and again there is no price paid. So 1650 and 1000, whatever is higher, that is obviously 1650, and so the taxable benefit would be 1650 plus 450, and that'll be 2100 for the tax year 17-18. So candidates must take care when it was gifted, whether it was gifted within the year or at the start of the tax year, because if it is the start of the tax year, you would only be calculating gift of asset and not use of asset. But if after certain months you have been gifted with some asset, in that case you will be calculating both of the benefits. Well, I have included an example of statutory mileage allowance over here as well. Let's talk about the next benefit in kind, and that is the beneficial loans. Well, make sure whenever you are provided with any loans which are above official rate of interest of 2.5%, that would give rise to a taxable benefit. Below 2.5%, that would give rise to a taxable benefit. For example, if my employers provide me with an interest free loan, well, in that case taxable benefit will be 2.5, and if I'm paying 1% interest, well, in that case 1.5% would be your taxable benefit. But if we repay amounts, or if the outstanding amount of the loan changes during the year, we have to use these two methods in order to compute what is the taxable benefit, and we pick lower of both. But candidates should take care, if the same loan, even if it is interest free, it is provided to provided but for any of the qualifying purposes which we were discussing in the start of this session, well, in that case this benefit would be exempt. Same goes with if an employer provided loan or loans does not exceed in any tax year an amount of 10,000, again benefit would be exempt. Now let's have a look at some example, so that we can have an idea that how to compute the benefits whenever there are certain repayments. Well, Dan was granted a loan of 40,000 by his employer on 31st March 17 to help finance the purchase of house. Now, we know the loan is not used for any of the qualifying purposes, and yes, it would give rise to a taxable benefit if employer would be charging an interest of less than 2.5%. Well, the interest payable on this loan was 2% per annum, so 0.5% would be the taxable benefit. On 1st June 2016, Dan repaid 6,000. Well, I think the dates are a bit messed up. So, he was provided with a loan. Right, now I think everything is fine. Well, then was granted a loan of 40,000 by his employer on 31st March 2016 to help finance the purchase of house. Interest payable on loan at 2%. And on 1st June 2016, Dan repaid 6,000, and on 31st December 2016, he repaid a further 15,000. Remaining 18,000 was still outstanding at 5th April 2017. And we will be focusing on tax year 16-17. Pardon my dates. Well, in order to solve this one, for accurate method, you should consider that for how many months what was the amount due. Well, it was 40,000 when the tax year 16-17 started, but when he made a repayment on 1st June, well, that means April, May, 2 months it was 40,000. Then he repaid 6,000 and it becomes 34,000, and it was 34,000 throughout June, July, August, September, October, and November for next 6 months. And then he repaid a further 15,000, and so we are left with a balance of 18,000, which was due throughout December, January, February, March. That will be another 4 months. So out of 12 months, 2 months it was 40, 6 months it was 34, and 4 months it was 18,000. So if you have a look at this accurate or strict method, you would say 40,000 at 2.5% into 2 by 12, then 6 by 12, and then 4 by 12. This would have been the interest which would have been payable if it was on official rate of interest, but it was on 2%. So on 2%, the tax amount would have been the amount which was actually paid was 473.3. So the actual paid interest and the interest which would have been charged if the loan would have borrowed from the market, the difference is this. Well, we have to take the lower off, so we should consider the other amount. Well, the other method says why to find out everything so precisely. Let's take an average of opening and closing balance, which is 40 plus 18,000 divided by 2. Multiply by 2.5%, and that is the official rate of interest which HMRC allows you the other way. But make sure still you have to deduct the same 473.3. And so the taxable benefit would be 251.7. As we have to count for lower of both, so that'll be 251.7. All right, so that would be gift of asset and use of asset. Well, if an employee is provided with scholarship, employee himself, if provided with scholarship or employer funded trainings or anything like that, that would be exempt. But if the scholarship has been provided to any connected person of the employee, well, in that case, it would be a taxable benefit unless both of these conditions are met. Now, there were certain other benefits which we had considered. Well, in fact, we did not consider while we were doing the example of living accommodation. Well, there were running cost of the houses. Well, there were council taxes paid. For that, let's have a look at this next benefit in kind, and that is ancillary services. Well, if the ancillary services or expenses which are connected with living accommodation are provided on private accommodation, which would be the case mostly in your paper, in that case, taxable benefit is cost paid by employer. And that was the reason why we included those amounts straight away into the pro forma. Now, let's have a look at this example again. We are done with what is the amount of living accommodation. But if you will see, there were certain other things also available. For example, along with the flat, he was also provided with furniture. Well, for furniture, I think you remember I've taught you the use of asset. So for 20% of the cost of the furniture, and then company pays 2,000 for the cost, running cost of the flat, as well as council tax of the flat. Well, ancillary services or running expenses related to living accommodation are straightaway taxable if paid by employer, and the taxable amount is the cost paid by employer. So, yes, whenever this will be living accommodation, you might be looking into living accommodation, then it's furniture, and then the running costs. All right. So coming back, but if it is living accommodation, which is for job related purposes, well, in that case, benefit is not exempt, but it would be lower off. Whatever the cost paid by the employer, which will be given in the exams. And second, employment income, in excluding ancillary services, we have to take 10% of that, and whatever the lower of these two, that would be taxable benefit. But in the exam, most of the times the accommodation which you will be looking into will be private accommodation, and in that case it's very simple, cost paid by employer. Now, there's a long list of these exempt benefits. Well, I have written them in a very clear and easy way, but I would not be discussing them as these are very straightaway things and easy. But you can always ask me if you have any problems related to exempt benefits, because what I always tell to my students is that these exempt benefits are important. You know why? Because when you will read or go through with these exempt benefits, you would find out that most of these benefits are provided to employee to serve some personal purposes, but still they are exempt. So far, the rule for an exemption on any benefit, which I have been repeating in front of you guys, was that benefit would be exempt if it is provided only and only for performance of duties. But now, right now, I am showing you a long list of certain benefits which are exempt, and yes, they are provided to employees for personal purposes. So these are very important because many of the employees would be interested in withdrawing money from their employer, which is in the form of an exempt benefit. So, in every other question of employment income, I'm not sure all the benefits I have been teaching you so far would be there or not, but I'm sure there would be around 2 to 3 marks in every question involving employment income relating to these exempt benefits. So I would strongly recommend do not forego this 1.5 page. So give it a good reading. Two of the very important benefits in kind, and those are grant of options and awarding of shares. Well, when we say options, make sure what we have been provided with. Well, make all of you know already that in P2, what are the options are actually? Well, these are exactly not the same options which we deal in P2, because those are the options which companies actually issue or grant in the market, and those are saleable options. Well, these are employee options. These are allocated for employees, and only employees could exercise them if they want to or they don't. Well, there have been in the exam scenario, you would be looking into both type of options, which have been granted by employer under an approved by HMRC, or under a scheme which is not approved by HMRC. Well, in the exam, we can say we both type of the share options are equally examinable. Out of every 10 questions, we can say yes, 6 of the times these are approved, and 4 of the times these are unapproved as well. Because this happens in the market both ways. So, if our employee, our client, is provided with an option in the exam, this is what he will be precisely interested in. That what would be happening to him with respect to income tax and NIC when the option would be granted, when the option would be exercised, and when these shares which were purchased through exercise of option would be disposed. Well, I usually used to tell my students that whenever options are in the exam, you can say without even reading the requirement, he is going to ask you what are the implications on grant, what are the implications on exercise, and what would be the implications on disposal. All right, so let's have a look at what are the implications when it is an unapproved and when it is an approved scheme. Okay, So when it is an either it is an approved or it is an unapproved scheme, make sure there are no implications at grant date. But yes, there would be some. If it is an unapproved scheme, yes, there will be tax implications. There will be a charge to income tax and NIC, or in simple language, I can call there could be a taxable benefit in kind. But there would be a taxable benefit in kind if there is some benefit in exercising the option. For example, if on the exercise date, market value per share was £10, the exercise price which was offered to the employee, if the exercise price was £12, obviously the employee would not be exercising the option. But if the exercise price being offered was, let's say, £6, and if the employee had to pay some cost of option at the date of grant to buy this option, well, that is not happening in every scenario. Most of the employers do not charge any cost of option when they provide these options to their employees. Well, some of the employers do. So if an employer do charge a cost of option, we are again allowed to deduct it. For example, if it was zero point 0.5, we would be saying there would be a taxable benefit in kind per share of 3.5. Now, in order to know whether NIC is chargeable on this taxable benefit or not, for that we have to wait till we discuss national insurance contribution. But this is taxable benefit in kind if it is an unapproved scheme. So there would be a charge to income tax and NIC at exercise date if it is an unapproved option. But what would be the CGT base cost for these shares for this individual for future disposal? Now, as you can see, this share cost him 6.5. He paid tax on 3.5. So from now onwards, the CGT base cost should have been pound 10, or else we should say for this person, now the gain would be any amount which is above 10. And if it is below 10, it should be an allowable loss. And that's why for future disposal purposes, the CGT base cost will be market value at exercise date. So, for example, after some times after the exercise date, for example, if the individual was able to sell these shares at £18, he'll be deducting £10 out of it, and the gain chargeable would be £8. Now, many of my students ask whether these shares qualify for entrepreneur's relief or not. Well, every share could qualify for entrepreneur relief if the person who is disposing them is at least 5% shareholder of the company and is also employee or officer, and all of these conditions were complied with for a year. Otherwise, no, entrepreneur relief would not be available upon them. So for entrepreneur relief, yes, we have to fulfill the conditions for entrepreneur. But on the other hand, if the same option would have been granted to the employee under an approved scheme, the benefit would be there would be no tax implications on grant date, as well as the benefit being realized on exercise date would be exempt. Now, for instance, if I say that market value on exercise date, I'm using the same data so that you can compare the both treatments. So if the same data would have been used over here, once again, the market value on exercise date was pound 10, our client paid 6 and then 0.5, and that means 3.5 pounds would have been the benefit he had realized, but the benefit is exempt, so nothing will go into employment income, or there is no charge to income tax and NIC. And as he did not pay any taxes on 3.5, so we cannot say his future base cost would be £10 in this case. And that's why the future base cost in this case would still remain at whatever he paid for it. As in the earlier scenario, he paid 6.5, but he paid income taxes on 3.5. And that's why his future base cost was marketable in exercise date. But now the future base cost is 6.5, the price he had actually paid for it. And now in this case, if he would be able to sell it at 18, there would be a chargeable gains of 11.5, which happens to be sum of both. So yes, what actually an approved option gives us? Well, the benefit which would have been chargeable to income tax and NIC ultimately converts into the gain chargeable, which is far more tax beneficial for us as compared to any unapproved scheme. Because if my income is gonna be converted into chargeable gains at some point in future, well, the first benefit is some point in future, not now at the date of exercise. Well, the second benefit is rates of CGT are quite less as compared to the rates of income tax. And the third benefit, on CGT, we do not have to pay any NICs. So, this is the treatment of any individual who might be asking you that what are the tax implications on grant date, on exercise date, and on disposal date if it is an unapproved scheme or if it is an approved scheme. Well, all of the approved schemes behaves in the same way except for EMI. Well, EMI also behaves like other approved schemes, but in one case, there might be a charge to income tax and NIC, or we can say there could be a taxable benefit in kind rather than being exempt on exercise date in an approved scheme. So we will be discussing that when and how this happens. But before that, I would like you all to spend around 10 to 15 minutes in order to go through all the conditions I have set over here in respect of the approved schemes. Well, we have three of them. One is save as you earn. Second is company share option plan. Well, let me give an introduction to these options. Well, the first one is called save as you earn. Second is called CSOP, company share option plan, and last one is called EMI. Well, say should sometimes in the questions of corporation tax, when we are dealing a client which is a company, well, the management of the company would be asking you that we want to set up a scheme, an approved scheme for all of our employees. If they wanted to give away options to everyone, starting from managing director to the officers and every employee in the company, well, the scheme to be suggested to such clients would be say, because it says it should be if an organization wants to give away share options under say scheme, it must give to everyone on similar terms in the organization. Well, CSOP is selected by those companies who want to benefit a specific group of employees. Well, I might be saying that it is sales department, whole of the sales department I want to benefit to, or maybe it is all the directors I want to benefit to, or maybe it is all the managers I want to benefit to, or maybe it is a department I want to benefit to. And when you want to give away options to selected individuals, well, your choice should be enterprise management incentive scheme. Well, now you guys could go through all of the conditions which examiner might ask you to correct or to guide him. Well, I would not say that you have to remember by heart all of these conditions. You should be able to identify that what are the conditions, and you should be able to correct someone if he or she is providing you with a scheme he had designed. Well, in the exam, these conditions have been examined once or twice, but the way it was examined was that he had already written the conditions on himself by the knowledge the client already had. There were few errors in those conditions, and we just have to correct them. For example, in the exam, as we can see, the maximum contribution over here monthly is 500. In the exam, maybe he would say the maximum contribution we want is 600, and you would be correcting them. So I would not say that these conditions would be examinable just the way we have to rewrite them. Maybe it would be examined in a logical manner. So you should have a good reading of these conditions. But what I would be discussing with you guys, and I've already provided the tax, that what is the tax treatment? Well, the tax treatment for all the schemes, as far as approved schemes are concerned, either SAE or CSOP or EMI is considered. Well, the tax treatment is what I have discussed. This is the tax treatment for all of those. Except for EMI, in certain cases of EMI, we have certain exceptional calculations to do. So I would be discussing that exceptional treatment on EMI. So I'm kind of hoping that you have no problems relating to the conditions of say CSOP. Well, there are a few things which I would like to still mention. So let's have a look at those, and then we'll be talking about EMI. Well, if we talk about SAE, what are the certain points we should consider? Well, as far as SAE is concerned, make sure in this case, people, how SAE scheme works out. Well, at the date of grant, we back up this scheme with a SAE fund, and employees contribute monthly in order to gather an amount to be used for exercising of option. So rather than getting an upfront amount on the exercise rate from the employees, what employers are usually required to, they set up a say fund. They ask the employees for monthly fixed payments, which could be not more than 500 a month. And at the date of exercise, clients or employees may either use this money to exercise the option, or maybe they would be they could draw the money if they want to. But make sure, as it is an approved scheme, either they withdraw the money in cash or they exercise the option. There could not be any taxable benefit in kind on the date of exercise, being an approved scheme. Well, the only charge would be towards capital gains on later disposal of these shares. As far as company share option plan or EMI is concerned, no, it is not backed up with any fund like SAE. In this case, make sure employees who would be granted options under CS or EMI, they would have to pay upfront all the exercise price at the date of exercise. Well, the options which might be allocated under CSOP up to the maximum of 30,000 per employee a year. Now, this is what I would like to mention over here, that, for example, at the date of grant, when the options were at the date of grant, when options were granted, at that date, let's say if the market value was pound 10, make sure the maximum entitlement which you have to find out, let's say at grant date market value was pound 10 and an exercise date market value was pound 15. Make sure in order to find out that what is the maximum number of shares an employee would be granted, because in the exams sometimes we are told that Mr. XYZ will be granted with maximum entitlement of CSOP. Well, in that case, you would be unaware of what is the number of shares being allocated to this person under this option. So in order to find that, you should keep in mind the maximum entitlement is 30,000 per employee. And how this 30,000 is precisely considered? An employee would not be allowed shares worth more than 30,000 pounds with respect to market value at the date of grant. So, yes, this is per employee at any time. Well, if I have already maximum entitlement of 30,000 share worth of shares, I would only be allocated next CSOP when I will exercise few of these shares, or maybe all of them. So at any time, you should not hold more than this value. Well, so if it is pound 10 at market value, pound 10, well, in that case, you would be telling your client that you would be getting 3,000 option to buy 3,000 shares at exercise date. So what I want you to know is, if you ever have to calculate number of shares for CSOP, you have to use 10 pounds with respect to the entitlement. If he says maximum entitlement, you would be dividing 30,000 with market value at grant date. If he says half of the maximum entitlement, in that case 15,000 is to be divided with market value at the grant date. Well, the exercise period in SAE was either 3 or 5, but over here it is from 3 to 10 years. So anything within 3 to 10 is acceptable. As far as treatment is concerned, there are no implications at grant, there are no implications at exercise, and there would not be any implications. There would be implications on later disposal, as disposal is not exempt under approved schemes. Well, when it comes to enterprise management incentive, as I mentioned earlier, it is a scheme which is set up by a company when a company wants to allocate options to selected individuals. Well, as you can see, the relevant value to be allocated in this case is quite higher as compared to CSOP, that is 2,50,000. But a very important point is this 250,000 is subject to what an individual has already been allocated options under CSOP. Now, if I say I already have maximum entitlement of CSOP, what would be my maximum entitlement for for EMI? So that would certainly be 2,20,000. So make sure the maximum entitlement limit is 250,000, but this limit is subject to what you have been already provided under CSOP. All right. The next thing which are important with EMI is which of the companies qualify to set an EMI scheme. Well, this is what you can see, what you can say is a condition which we usually look into our exams whenever EMI comes, that whether the company qualifies or not. Well, every company qualifies if there are not more than 250 full-time employees Gross assets are not more than 30 million, and it should not be dealing in either property development or any excluded activities, that is, companies dealing in shares, commodities, futures, or property development, or steel and coal mining, or accountancy and legal services. So, any company who is not dealing in any of these activities, having employees of up to 250 or less, or gross assets of 30 million or less, in short, we can call every SME is entitled to set up EMI schemes. The other thing which we have been asked many times in the past papers is the company is allocating scheme to a specific employee, whether that specific employee qualifies for EMI or not. Well, for that, you should look into the working hours of that employee. If an employee is working for at least 25 hours a week, every such employee qualifies for EMI options. Or if someone is not working for 25 hours, then he must be giving at least 75% of his working time to this particular company in order to consider himself a qualifying employee for this scheme. Well, if someone is not working for 25 hours nor giving 75% of the working time to a company, well, such company, if provides share options under EMI, well, those will be considered as unapproved options for such individual, and there will be a charge to income tax and NIC at the date of exercise. Um, there is no minimum period of exercise over here. So it could be up to maximum of 10 years, but there is no minimum. So you can grant an option right now, and you can set an exercise period of after a month even if you want to. But there is something very important, very, very, very important, which candidates must know is that entrepreneur relief is always available on EMI shares regardless of the percentage of holding. That is, there is only one type of share option which says that employees are not required to hold 5% holding of the company in order to claim entrepreneur relief, because EMI is the only share option. If you acquire shares under EMI, they will qualify for entrepreneur relief regardless of you being 5% shareholder or not before disposing of the shares. So there is no restriction of holding of minimum 5% shares if the shares being disposed were acquired through EMI share options. And there is also an other tax implications which is important when it comes to EMI. As we can see that other options have strict guidelines that what should be the grant market value, what should be the exercise price. If we talk about, for instance, SAE, well, SAE says whatever the market value at grant date is, the exercise price should not be more than 20% discounted to market value at grant. For example, if the market value at grant date is £10, under SAE, I cannot offer an exercise price below £8. Well, in EMI, things seems to be quite generous, but it's not the way it seems to be. That option could be granted at discount or premium with respect to market value at grant date. Well, if you can do that, but there will be some implications which you have to face at exercise date if the option was granted at discount with respect to market value at grant date. Well, the implications are different when if it is SAE or if it is EMI. For example, according to SAE, if the market value at grant date is £10, I am not allowed a discount of more than 20%. So exercise price has to be pound 8 or more. If it won't, my say scheme would be considered as an unapproved scheme. But in EMI, if the market value at grant date was pound 10 and I offer, let's say, even 7, the initial rule says no problem. It would not become an unapproved scheme. But there would be charge to income tax and NIC of £3. For example, under EMI, if I have been granted an option to purchase shares at pound 7, where the market value at grant date was 10, make sure there would be a taxable benefit in kind, but not at grant date, at exercise date. Well, at exercise date, this £3 would become taxable benefit in kind, and it would give rise to charge to income tax as well as NIC. Well, in this case, make sure from now onwards my CGT base cost would not be pound 7, which I paid usually in the case of any approved scheme. It would become pound 10. Well, these things would be much, much more clear to you guys when we will be discussing the scenarios relating to share options. Right now, I would like you to focus on another important thing, which is called payments on termination, resignation, retirement, or redundancy. Well, if someone is made redundant or been retired or he has resigned on his own, there are certain payments we usually hear around us that he has received. Well, make sure some of them are completely taxable, some of them are completely exempt, and some of them are partially exempt. Now, I would like to mention that although it is just a 3-column, 1-row table, but I have seen this more times as compared to any topic of employment income in your exams. If we analyze the past papers, you would not see share incentives or share options that much time in your paper, as much times he has been asking you about these payments. Well, let's have a look at which of the payments are which are completely taxable and which are completely exempt and which have part of them being exempt. Well, all those payments which you receive under golden handshakes, that is, if you are being forced to leave your employment even before the term of employment. So as a settlement, you get golden handshakes which are completely taxable. Or if your employer at redundancy or retirement or resignation impose some restrictive covenants on you that you cannot work with any of my competitor for 6 months, or you should not be starting your own trade in the same industry for next 1 year, and for that if a compensation is paid, once again it would be completely taxable. Or if someone has been paid an amount because he was not given the stated notice period in the contract. So if I have been asked, so if in my contract I have to inform my employer to leave before resigning of at least 6 months, and that goes both ways. If my employer has to make me redundant, he would have to give a notice period of 6 months. And if he gives me anything less, he would have to pay for me. He would have to pay in respect of those months to me. Well, that is called payments in lieu of notice, and that is completely taxable. On the other hand, those payments which are received and are completely exempt are payments which are received on retirement from the pension fund. As if you guys would have an idea that when a person would retire, you get two types of benefits from such retirement. For example, There is a lump sum amount which we receive, and then there is a pension monthly income which we receive. Well, the monthly income is completely taxable, but whatever the lump sum amount we receive in the year of retirement is completely exempt. All right, the next thing is statutory redundancy payment. Well, examiner is quite generous about this one as he always named it, and you just have to know that this is the payment which is paid to you by statute, by law, by employment law, which is your right, is completely exempt. So there are two payments which are completely exempt: lump sum portion on retirement from pension, and the second is whatever is your employer required to pay by statute by making you redundant. That is completely taxable. Now, the payments which are given to you not for your performance of duties, they are given to you as ex gratia, are exempt but not completely. They are exempt up to an amount of 30,000. But once again, there's a problem in this 30,000. This 30,000, the partial exemption limit of ex gratia payments, is subject to what you have already been paid under statutory redundancy payment. So, for example, if I say that I have already been paid a statutory redundancy payment of 10,000, what is the amount of ex gratia I am able to receive as an exempt income? So your answer would be 20,000. So the ex, thank you so much, Carolyn, that's quite correct. But if I have received a statutory redundancy payment of 42,000, what is the amount of exempt ex gratia? Well, I think nothing, because in this case you would say the limit of exemption was just 30,000. This 42,000 which we received under SRP is completely exempt as said by HMRC, but being 42,000, it has consumed all of this limit, and now whatever ex gratia payments you receive would be completely taxable. There is no exemption available. So I would say you should keep in mind these payments on termination or redundancy, because I would say these are quite important. I have seen them many times in your exams. Now, in the last 10 minutes of this session, I would like to discuss NIC and implications of NIC on grant of options and grant of options, exercise of options. Now, if you know that the NIC is a payment which is, or we can say an other tax which we have to pay on our incomes. So right now we are going to discuss class 1 NIC, which is relevant to employment as we are discussing employment income. So right now we have class 1 NIC. Class 1 has its further three categories. First is called class 1 primary, or you can call it class 1 employee NIC. Class 1 secondary, or you can call it class 1 employer, or we have class 1 employer A. Well, as the names suggest, it belongs to employment income of an employee, but employee just is required to pay one of that, and that is class 1 employee NIC. Well, the other two NICs are calculated on taxable benefit of employee but paid by employer, and is an exempt benefit for employee and allowable expense for employer while computing his or her trading profits. Well, as far as calculation is concerned, you have to gather or accumulate all those benefits which were received by an employee, which has these two characteristics: benefits which are taxable and received in the form of cash. Well, the common examples are these. When we talk about shares, whether the share is chargeable to primary and secondary NIC, share options. Well, the share options, as we can see, there is a taxable benefit in kind at the date of exercise in the case of unapproved option, and there would be a taxable benefit in kind in the case of even an approved option if it was EMI granted on discount. So in both cases, yes, there would be a taxable benefit in kind, but the question is whether that taxable benefit in kind is chargeable to primary or secondary NIC, or whether that taxable benefit in kind is chargeable to class 1 ANIC. Well, all the cash equivalents are chargeable to primary and secondary. Well, whether the shares are cash equivalents or not, I think if the shares are of a quoted company, yes, they are cash equivalent, because if we want to sell them, we can sell them. But to sell shares of an unquoted company would be a difficult task to do, and that's why we do not consider them cash equivalents. So if there's a taxable benefit in kind on exercise of an option, employee would have to pay class 1 primary and class 1 employer would have to pay class 1 secondary NIC if this taxable benefit was in respect of grant of shares of a quoted company. So the client, the employee who might be asking you the income tax and NIC implications in your exams, you just have to notice whether his employer company who's granting options is a quoted company or an unquoted company. Because if it is an unquoted company, employee would not have to pay any NIC because it would not be a cash equivalent. Rather, employer would have to pay class 1A on it. But if it was of a quoted company, in that case, employee would have to pay class 1 primary on it, and employer would have to pay class 1 secondary on it. Well, as far as the rates are concerned, I have given them over here for your consideration. And so, in the nutshell, if we want to summarize that how these rates and on what amount these rates are to be applied, well, make sure I would say that you should try to memorize the class 1 primary, secondary, and A in this manner, because in this manner, that which of the NIC is payable by whom under what circumstances. Well, if it is a taxable benefit which is received in the form of cash or cash equivalents, employee would have to pay NIC primary, employer would have to pay NIC secondary. But if it's a non-cash benefit, employee is not required to pay any NICs, only employer is required to pay NIC, and that is class 1A. Well, the rates of class 1A is a flat 13.8%, unlike the rates of other two NICs, in which we have nil band, 12% band, at least nil band, but in class 1A, there is no nil band available. So straight away, 13.8% on all the benefits which are received non-cash. For example, living accommodation, for example, fuel benefit, for example, beneficial loans, and things like that. Well, that would be all. Take care. Bye-bye.